Welcome to Property Showcase, the podcast that brings you closer to the service providers that can inform your decisions about how you buy, manage and research top investment opportunities. Be informed and become a better investor with Property Showcase.
Our first guest today is Son Pham. Son is the head of mortgages at Rethink Investing. Hello, Son, and thanks for joining us.
Thank you. Thank you for having me.
You're very welcome. Now, having a mortgage is one of the cornerstones of the investment cycle, but I would imagine that having the right mortgage is even more important than just having a mortgage. So how should an investor go about getting their mortgage in place before starting out in the cycle? What are some of the things they should be looking out for?
What we should do first is, get all your financials together and make sure that there isn't anything fishy going on or anything suspicious. The banks are all tightening down on, serviceability. Can clients really afford to get this loan? And they're really harping on, living expenses. So they want us to investigate and make sure that there isn't anything hidden. So just getting the pre-approvals in place, talk to the right people for the right structures. Everything here is, general advice. We're not going to give financial advice, but, people need to really consider what their goals are. And the structure of the loan will determine where they go, whether they put it in a trust or individual names, self-managed funds, stuff like that. Yeah.
So there's a couple of options that they have available to them. And I guess what you talk about having the goals or considering the goals first up before they get started, I suppose that's really important because you don't want, they don't want to paint themselves into corners mortgage-wise if they've got long-term ambitions as they grow.
Correct. Yeah. It shouldn't just be about, I just need a loan. I want this property. Getting the property is part of it, but the mortgage, the structure is very important as well.
And then also just determining how they're going to do it and as they grow, whether it's going to, as you say, be in a trust or some kind of other vehicle.
Correct.
And some of the pitfalls, Son, some of the things that you've seen in your experience that investors can trip up on as they progress.
I guess overcommitting, getting into a property and realizing that, I can't afford it. I guess that's why things like interest only can help. But, in the last 2 years, lending has tightened very much so. And if you actually took out an interest only loan, you're actually shooting yourself in the foot because your serviceability is lower, the way they're assessing it. So what we're finding is, a lot of clients who had taken out interest-only loans in the last few years, 5-year interest-only terms are all starting to mature soon, next year or so. And I don't think people realise that it's going to go to P&I rate and generally could be a substantial increase. And they'll find that they can't afford to pay it. And then next thing you know, they're going to try to sell their properties. And if everyone's trying to sell, it's not the right time.
So that would be probably quite a serious impediment. So again, just forward planning and understanding and probably being really aware of what they're getting into because
Correct.
Interest only today is going to expire at some time.
That's
and then
right.
there's going to be, life after that.
That's right. So I guess, P&I hasn't always been the strategy. I mean, if we rewind the clock, we used to do interest only, no problem, because it is less cash flow, I guess, or more cash flow for you because you're paying down less. And you can redirect that to, your owner occupied, if that's the goal, to pay that down as quickly as possible. But now it's totally different ballgame, because what you find is 3 or 4 properties, all interest only, it's going to hit you. So what we do is we talk to some of the clients now and, if they can afford to do so, we do it on P&I because in that way there's no kind of hidden, expectation or when the loans, it won't mature anyway. So there'll be consistent repayment. Yeah.
You talked a little earlier about tightening credit policies, and I guess that might have something to do with the recent sort of APRA changes, the earlier APRA changes, and now just recently APRA's loosened up on that, or?
No, I think if anything, it's just getting stricter and stricter. So there's a whole heap of stuff happening. One of the things that just happened most recently is as of 1st of July, we've had comprehensive credit reporting. So what's happening now is back then, if you were naughty, they would, report you to the credit agency so that, if you defaulted or missed payments or whatever. But now they're actually reporting you, even if you're good. So if you've got credit cards that you don't use, they're still going to report you to the agency. So what you'll find is, it's very hard to now, not disclose anything to the banks. The banks are going to know everything. So that's one of them. The biggest thing is living expenses, as I mentioned previously. The lenders want us to sit with customers and actually go through budgets and try to understand, can they really afford these loans. So that's what they're harping on at the moment. Yeah. So if anything, it's just getting tighter and tighter.
Sounds like there's no corners to hide in.
No, definitely not. Definitely not.
One last question from me, Son. Just in terms of your mortgage division, how does it support the overall business, I guess, of Rethink Investing?
Yeah, look, at Rethink, the strategy is to get high cash flow properties. So that's a help, because I guess when you go to borrow, make it very simple. The more income you have, the more you can borrow. So if you're buying something in Sydney worth $1 million and you're getting 2-3% yields, your borrowing is going to get shot. Whereas if you're buying something much more affordable and the yields are much higher, your borrowing capacity is just as good, or can keep going. So Rethink, we look at those positively geared properties, high cash flow, and then we look at lenders as well. So we choose particular lenders to show to our clients, I guess, because it comes down to policy. Not all lenders like, multiple property investors. I know certain lenders, they look at them, they get scared. They shade the rental to like 60% for servicing, 70%, 80%, depending on who you go with. But there are particular lenders that we like because their policies, I guess, not as strict. And they will allow the investor to borrow a little bit more.
Thanks, Son. Now, if anybody wants to learn more about Rethink Investing or anything else that we've chatted about today, how can they find you?
They can go to our website at www.rethinkinvesting.com.au, or they can call the hotline, I guess, 1300 965 551.
Thank you very much, Son. Thanks for your time today.
Nice, thank you.
Nice work. Our second guest today is Michael Beresford, regular guest on the show now. Michael is the Director of Investment Services at OpenCorp. Hello, Michael. How are you, mate? And thanks for joining us today.
G'day, Tim. Going well. Good to be with you again, mate.
Nice work. So there's lots to chat about. Well, there's lots of chat going on about cooling markets right now, and that the good times might actually be behind us. But you don't entirely agree with this, do you?
No. So as the regular listeners to this show will probably remember, I guess one of my bugbears is hearing the media, talk about the Australian property market as if it's a single beast unto itself. There are markets within different capital city markets. There are different markets within states. And as a result, there are many markets within Australia, and no doubt some of those are cooling, and the media reports are accurate around that. But I don't think it's fair to be able to paint every different type of market and every location within Australia with the same brush. That's not the way that we see things today, and it's definitely not the way that history has seen different markets cycle over the journey. So, I guess to use a specific example for you, we're hearing the press being dominated about, how Sydney, the median house price in Sydney's come back by about 5% since the height of the market. I'm sure those people in Sydney listening to this show that have owned property in the last 5 years or longer, are going to be very happy with the net 70% increase over the last 5 years. So. And conversely, Perth has been very flat during that time. Equally, when Perth has its moment to move, chances are Sydney will be flat, and that's how those different market cycles work. So we see a lot of opportunity in the major capital cities around Australia, definitely Brisbane at this point in time. And the reason for that is I guess that we've never seen a gap so large in percentage terms between Sydney's median house price and Brisbane's median house price. When you look historically and you do all the data charting and analytics that we do here at OpenCorp, basically what you see is once that gap gets to a really high level like it is today, quite quickly the gap is reduced. And that's a general indicator that we see, investment is cherry ripe in Brisbane, and that's really what we're focusing on.
It's a good way of thinking about it, and certainly the idea is not new, but it's certainly useful to think about the sort of many markets, and as one presents a hurdle, another one presents a space, and that always presents a lot of opportunities. So give us an idea of the plans that you have for yourself and for your clients to explore these spaces, this value through the rest of the year, through the rest of 2018.
Yeah, so I guess really what we are focused on is some select pockets within Melbourne, mainly for clients who don't have exposure to the Melbourne market currently. Again, as I was saying, there are different markets within even a capital city. So even though the Melbourne market has been growing strongly for the last 3 years or so, there are pockets of Melbourne that have really only started to see rapid growth in the last 12 to 18 months. And when you look at the fundamentals of supply and demand, we're confident that growth will continue based on proximity to jobs and affordability. No doubt, though, the majority of what we're looking at is in Brisbane, specifically in areas that are focus areas within the South East Queensland Regional Plan. That really indicates, I guess, where the money's being spent and where they see the development happening. So, in terms of what we've been seeing on the ground at OpenCorp, the inquiry has been through the roof in the last kind of 3 to 4 months, especially from new clients within Sydney, and to a lesser extent from people within Melbourne that have seen and had a timely reminder in the last few years about how quickly prices can grow when capital city markets do go through that growth phase. And what they're wanting to do is get exposure to the next Sydney or the next Melbourne by buying in Brisbane, but just, I guess, don't know the areas, don't have the time to be able to research that, but are becoming more and more savvy. I think generally investors are becoming more and more savvy around not buying so much in the area that they know or the area where they live, like many people used to in the past, and realising that they can get exposure to the different capital city markets around Australia and build a diversified portfolio that produces a far better financial result, as an outcome.
And in terms of building that diversified portfolio and exploring sort of further boundaries, if you like, it's quite important, and it's sort of an important position to take, to be sort of open and optimistic about things, which is largely about turning negatives into positives. How do you go about doing that, Michael?
I'm a pretty optimistic person, I guess, generally, Tim. But I think from the 15 to 20 years or so that I've been, investing and owning property, I guess I've kind of got the benefit of that hindsight, where I can see that not all the markets move at once. And the biggest thing that I love, and it comes from Warren Buffett, is when we start to see negative press, I see the opportunities simply increase, because it takes those people that are influenced by the media out of the equation, and I guess less competition means that I can buy better, in terms of what I'm adding to my own portfolio. So, I'm sure most of your listeners have probably heard it. If they haven't, it's a classic. I'll give it to you. But Warren Buffett says, "Be greedy when people are fearful, and fearful when people are greedy." So we'd definitely be steering clear of the Sydney market 12 months ago, when it was at the height of the boom and had seen 4 to 5 years of growth. But when people start to get fearful because of this negative media, just because of what's happening in a certain pocket of the Australian property market, then that really provides a positive outcome and a great opportunity for those that, I guess, understand the fundamentals of what drives growth, and can take advantage of that. Thanks, Michael.
Nice insights and advice as always. Now, if anybody wants to learn more about OpenCorp or anything that we've chatted about today, how can they find you?
Yeah, head to our website, www.opencorp.com.au. We do a lot of educational videos. Connect with me on LinkedIn, because we post all of them there, or you can give us a call directly at 1300 OpenCorp. We'd be more than happy to talk to you and sit down and have a look at your situation one-on-one.
Fantastic. Thank you, Michael. Thanks for your time today.
No worries at all. Good to talk to you, Tim.
Nice work. Cheers, Michael. Thank you.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.